A phone call just changed everything. 3 days ago, one of America's largest silver dealers made a statement that sent shockwaves through the precious metals community. Not a press release, not a carefully worded corporate memo, a raw, unfiltered admission that the price of silver we're seeing on our screens right now, it's a lie. And the real number? It's so far off from what Wall Street is telling you that even seasoned traders are questioning everything they thought they knew about this market. This isn't conspiracy theory. This isn't forum speculation. This is a major dealer, one who moves millions of ounces per month, telling customers that the physical market and the paper market have completely divorced. The spread between what silver is trading at on the COMEX and what it actually costs to acquire physical metal has exploded to levels we haven't seen since the 2011 blow-off top. But here's what makes this moment different. Back then, premiums spiked because of panic buying. This time, the premiums are rising while most retail investors aren't even paying attention. The smart money is moving in silence, and when the crowd finally wakes up, there won't be any metal left to buy. So what exactly did this dealer say? And why are central banks, mining executives, and institutional traders suddenly scrambling behind closed doors? Let's rewind. Let's look at the data they don't want you to see. Because what's happening right now in the silver market isn't just about one metal. It's a warning shot across the bow of the entire global financial system. Here's what happened. On January 18th, 2026, a senior executive at one of the top 5 silver bullion dealers in the United States held a private client call. During that call, he dropped a bombshell that leaked onto social media within hours. He said, and I'm paraphrasing here, that the dealer is paying $17 to $19 per ounce over spot price just to secure physical inventory from refiners and mints. $17 to $19. Let that sink in. At the time of that call, silver was trading on the COMEX at around $31 per ounce. That means the real acquisition cost for physical silver was pushing close to $50 per ounce, nearly double the paper price. Now, premiums exist. They always have. Dealers mark up coins and bars to cover production costs, logistics, and profit margins. But historically, those premiums run between $3 to $6 per ounce during normal market conditions. What we're seeing now isn't normal. It's a full-blown supply crisis masquerading as business as usual. And here's the kicker. This isn't isolated. Multiple dealers across North America and Europe have quietly raised premiums over the past 8 weeks. Some are refusing to lock in prices more than 72 hours in advance. Others are limiting order sizes or delaying shipments because they literally cannot source enough metal to fulfill demand. The U.S. Mint reported in early January that sales of American Silver Eagles hit a 6-year high in December 2025. But production hasn't kept pace. Mints in Canada, Australia, and Austria are reporting similar backlogs. And refiners? They're working overtime, but the raw material, the actual mined silver, is drying up. Why does this matter? Because silver isn't just a shiny rock people collect. It's the backbone of modern technology. Solar panels, electric vehicles, 5G infrastructure, medical devices, defense systems. Every single one of those industries is consuming silver at record levels. And unlike gold, which sits in vaults doing nothing, silver gets used. It gets consumed. And once it's alloyed into a circuit board or a solar cell, it's economically unfeasible to recover. We're burning through above-ground silver inventories faster than we're mining new supply. And now, the physical market is screaming what the paper market refuses to admit. There isn't enough to go around. So how are global markets reacting? On the surface, not much. Mainstream financial media has barely covered this. CNBC mentioned it in passing. Bloomberg ran one article buried on page 3 of their commodities section. The silence is deafening. But behind the scenes, panic. Central banks in Asia have been net buyers of gold for nearly 2 years. But reports from refining sources in Switzerland indicate a quiet shift. Private orders for silver, large institutional orders, have increased 37% quarter over quarter. These aren't coin collectors. These are sovereign wealth funds, family offices, and resource-focused hedge funds positioning for something the public hasn't priced in yet. In China, domestic silver demand has surged as the government doubles down on its renewable energy infrastructure. Beijing is building solar capacity at a pace that would require an estimated 12,000 metric tons of silver per year just for new installations. That's roughly 10% of global annual mine supply dedicated to one country's solar ambitions alone. Meanwhile, India, the world's second largest consumer of physical silver, just entered wedding season. Cultural demand for silver jewelry and gifts traditionally spikes in January and February. But this year, prices in Mumbai have already risen beyond what middle-class families can afford. Jewelers are reporting that customers are walking away from purchases or substituting silver with cheaper metals. When the people who've bought silver for centuries start getting priced out, something fundamental is broken. In the West, things are quieter but no less significant. The COMEX, the exchange where silver futures are traded, holds a fraction of the physical silver it theoretically backs. Recent data shows that for every ounce of physical silver in COMEX vaults, there are over 300 ounces of paper claims against it. That's a leverage ratio that would make any risk manager sweat. And yet, the price? Still hovering in the low 30s. The disconnect has never been wider. Let's dig into the data. Because numbers don't lie, even when markets do. Global silver mine production peaked in 2016 at roughly 900 million ounces per year. Since then, it's been in decline. By 2024, production had fallen to around 830 million ounces. That's a 7% drop over 8 years. Not catastrophic on its own, but here's the problem. Demand didn't drop. It exploded. Industrial demand for silver grew from 470 million ounces in 2016 to over 600 million ounces in 2025. Solar panel manufacturing alone now consumes over 140 million ounces annually. Electric vehicles add another 50 million. Electronics, medical applications, and 5G infrastructure account for the rest. Investment demand, bars, coins, ETFs, adds another 200 million ounces. That puts total annual demand north of 850 million ounces. We're consuming more than we're mining. And the gap? It's being filled by above-ground stockpiles that are quietly evaporating. The Silver Institute estimates that visible global inventories, metal sitting in vaults, warehouses, and ETFs, have declined by nearly 20% since 2020. COMEX inventories alone dropped from over 400 million ounces in 2021 to under 260 million today. That's a 40% drawdown in less than 5 years. And then there's the refining bottleneck. Even if miners could ramp up production tomorrow, refiners are already running at capacity. Lead times for minted coins have stretched from 4 weeks to 12 weeks. Some mints have stopped taking new orders entirely. But then the data took a darker turn. Analysts at CPM Group recently published a report showing that nearly 70% of global silver production comes as a byproduct of mining other metals: copper, lead, zinc, and gold. That means silver supply is constrained by the economics of those base metals, not by silver's price alone. If copper prices fall, copper mines slow down, and silver production falls with them. The market has almost no pure-play silver mines left to ramp up when demand spikes. Translation: silver supply is structurally inflexible, and when an inflexible supply meets surging demand, prices don't rise gradually. They explode. This isn't the first time we've seen this movie. Let's go back. Let's look at history. Because markets rhyme, and the patterns are impossible to ignore. In 1979 and 1980, the Hunt brothers attempted to corner the silver market. They accumulated over 200 million ounces of physical silver in futures contracts, driving the price from $6 per ounce to a peak of $50 in January 1980. The physical market seized up. Premiums skyrocketed. Dealers ran out of inventory. Sound familiar? The Hunt brothers' scheme collapsed when regulators changed margin requirements, but the underlying dynamic, physical scarcity, driving a wedge between paper and real-world prices, was real. And it took years for the market to stabilize. Fast forward to 2011. Silver hit $49 per ounce during the commodity supercycle. Premiums on coins surged. Mints couldn't keep up. Investors who waited too long paid $18 to $20 over spot just to get their hands on physical metal. Then the bubble burst and silver crashed back to $15 by 2015. But here's where it gets shocking. The 2011 spike was driven by speculation and fear. The 2026 situation? It's driven by structural fundamentals. The world didn't need silver to function in 2011. Now, it's essential. Solar energy can't scale without it. EVs can't be built without it. The technology that defines modern life depends on a metal that's running out. And unlike 1980 or 2011, there's no strategic reserve. The U.S. government sold off its silver stockpile decades ago. Most governments don't hold meaningful silver reserves. When the music stops, there's no central bank cavalry coming to the rescue. History tells us that when physical and paper markets decouple, the paper market always loses. Always. The only question is how violent the repricing will be. So what's really driving this? What's happening beneath the surface that the headlines aren't telling you? First, let's talk about the green energy transition. Governments around the world have committed trillions of dollars to decarbonization. The European Union, the United States, China, India, every major economy is racing to build out renewable energy infrastructure. And silver is the critical input. A single solar panel uses roughly 20 grams of silver. Doesn't sound like much until you realize that global solar capacity is projected to triple by 2030. That's an additional 300 million ounces of silver demand per year just from solar. And that's a conservative estimate. But there's another layer, a darker layer. Behind closed doors, something else is happening. Central banks are losing control of inflation narratives. Despite rate hikes, despite quantitative tightening, despite every tool in the monetary policy playbook, real inflation, the kind people feel at the grocery store and the gas pump, isn't going away. Trust in fiat currency is eroding. And when trust in paper money falters, people turn to hard assets, gold, silver, real things, things that can't be printed. There's also a geopolitical angle. China and Russia have been stockpiling commodities for years. Not just oil and grain, but metals. Strategic metals, silver included. If, and this is a big if, the world moves toward a commodity-backed monetary system, or even just a multipolar reserve currency structure, physical commodities become the foundation of power. And here's the really uncomfortable truth. The futures market, the paper market where silver prices are set, is heavily influenced by a small number of large institutions. They can suppress prices in the short term by flooding the market with paper contracts, but they can't create physical metal. Eventually, the physical market wins. Always. What we're witnessing right now is the early stage of that reckoning. Let's break down the mechanism. Let's explain how this works, because understanding the machinery is how you see the future before it arrives. Silver trades on two markets. The paper market, futures contracts on exchanges like the COMEX, and the physical market, actual bars and coins you can hold. In theory, these markets should track closely. In reality, they don't. And right now, the divergence is extreme. Here's why. Futures contracts are leveraged. You don't need to own 100 ounces of silver to buy a contract representing 100 ounces. You just put up a small margin, say 10%. That leverage allows large institutions to influence price with relatively little capital. But physical buyers, they pay full price, they take delivery, they hold. And when enough physical buyers show up demanding metal, the paper market runs out of room to maneuver. This is what's happening now. Industrial users, solar companies, EV manufacturers, electronics firms are securing long-term supply contracts directly with miners and refiners. They're bypassing the exchanges. They're locking in physical delivery because they can't risk shortages. Investment buyers are waking up too, not the retail crowd yet, but the institutions, the ones who read refiners' reports and track shipping manifests. They're buying quietly, accumulating before premiums get worse. And the dealers, they're stuck in the middle. They're paying huge premiums to source metal, but they can't raise retail prices too fast or customers walk. So margins compress, inventory shrinks, and the system tightens like a noose. Eventually something breaks. Either the COMEX price surges to reflect physical reality, or the physical market decouples entirely, and the futures exchange becomes irrelevant. Either way, the investors still holding paper contracts when the music stops are going to learn a very expensive lesson. So what does this mean for currencies, commodities, and everyday investors? Let's start with currencies. If silver, and by extension, precious metals broadly, are signaling a loss of confidence in fiat money, we're looking at potential currency instability. Not hyperinflation tomorrow, but a slow, grinding erosion of purchasing power that accelerates when trust breaks. Historically, when this happens, central banks respond with more money printing, which only worsens the problem. It's a doom loop, and the only assets that survive are the ones that can't be inflated away. Real estate, commodities, precious metals. For commodities broadly, silver is the canary in the coal mine. If silver is in structural deficit, what about copper, lithium, cobalt? The entire green energy transition depends on metals that are becoming scarce. Prices across the board are going to rise. That means higher costs for consumers, lower profit margins for manufacturers, and a potential slowdown in the very transition governments are betting trillions on. For investors, the message is clear. Diversification isn't optional anymore. Holding only paper assets, stocks, bonds, cash, is a bet that the system stays stable. And right now, the system is showing cracks. Physical assets, gold, silver, real estate, even art and collectibles, are the hedge. Not because they always go up, but because they don't go to zero when currencies falter. But here's the uncomfortable part. Most people won't act until it's too late. They'll wait until premiums are $40 over spot. They'll wait until dealers have nothing to sell. They'll wait until the headlines finally catch up to reality. And by then, the opportunity will be gone. What happens next? Where does this go from here? There are three scenarios. Let's walk through them. Scenario 1, the best case. Miners ramp up production, refiners expand capacity, premiums stabilize, the market rebalances, and silver trades in a range between $35 and $45 for the next few years. Industrial demand gets met. Investors get their coins. Everyone moves on. Probability? Low. Because ramping up production takes years, not months, and demand isn't slowing, it's accelerating. Scenario 2, the squeeze. Physical shortages worsen. Premiums climb to $25, $30, $40 over spot. The COMEX price disconnects from reality. Investors flood into silver, driving a speculative mania. Prices spike to $70, $80, maybe $100 per ounce before crashing back down when speculative froth clears. Industrial users scramble. Governments intervene. Markets stabilize, but the damage is done. Probability? Moderate to high. This is the 2011 playbook with structural demand underneath. Scenario 3, the reset. Silver's scarcity exposes broader fragilities in the global commodity and monetary system. Other critical metals face shortages, inflation spirals, central banks lose credibility, hard assets surge, governments implement capital controls, export restrictions, or even nationalize critical resources. The financial system doesn't collapse, but it fundamentally changes. Probability? Lower, but not zero. And rising. No one knows which path we're on. But the signs are piling up. The dealer's admission, the premiums, the inventory drawdowns, the quiet accumulation by institutions, the silence from mainstream media. When all the signals point one direction, ignoring them isn't caution, it's denial. Let me leave you with this. What we're witnessing right now isn't just a market correction. It's not a temporary supply hiccup. It's a warning. A warning that the systems we've taken for granted, stable currencies, abundant resources, orderly markets, are more fragile than we thought. Silver is small. It's a $70 billion market in a global economy measured in the hundreds of trillions. But it's a bellwether. It's the place where physical reality and financial engineering collide. And when reality wins, when the paper burns and only the physical remains, that's when people realize what money actually is. Not digits on a screen, not promises from central banks, but things, real things, tangible things, things that have value because they're useful, scarce, and can't be conjured out of thin air. The dealer who made that phone call 3 days ago wasn't trying to cause panic. He was telling the truth that most of the market isn't ready to hear. But you heard it. And now the question is, what are you going to do about it? Are you going to wait until the headlines catch up? Until premiums double again? Until there's nothing left to buy? Or are you going to take this information, do your own research, and make the decision that's right for you and your family? Because history doesn't wait for the unprepared, and markets don't care about fairness. This isn't just a story about silver, it's a story about what happens when the invisible hand of the market finally closes into a fist. The question is, who's paying attention? If this resonated with you, if you see what's coming, hit that subscribe button, turn on notifications, share this video with someone who needs to hear it, because the next few months are going to be critical. We're going to be here tracking every move, every data point, every signal the market throws at us. This is just the beginning, and trust me, you don't want to miss what comes next.